Hello and welcome to a special episode of Simply Tax. Year-end tends to be an exciting yet busy time for all of us, and it was both a busy and exciting year in the tax world as we discussed on the podcast. So to help you cut through the static of the tax planning world, I invited my colleague Julia Dengel, who is the editor of BKD's Year-end Tax Advisor, to help me co-host today to highlight some of the insightful and practical articles in this year's edition. Now before we jump in and hear from Julia on what the Year-end Tax Advisor is, and why you should read it in the first place, I'd like to get your feedback on something. When we started Simply Tax, I had a baseline rule that the length of no episode would ever start with a number greater than 1, with a target of 10 to 15 minutes per episode. Well, based on feedback, and that it's pretty darn hard to chop and condense down some of the great insights from the guests that we've had on the podcast so far, you've probably noticed that we decided to scrap that rule and have since broken the 1 hour mark with one of our episodes. The episode you're listening to right now weighs in at the longest so far, and I'd really appreciate it if you'd email us at simplytax@bkd.com to let us know what you think. Is it too long? Too short? Just right? I really want to hear from you, and if you drop us an email, we might even sweeten the deal by sending you some Simply Tax swag as a thank you for providing your feedback. As you probably know, we provide show notes to all of our episodes, which you can find at bkd.com/simplytax. But I think you'll find the show notes of this episode particularly helpful, as we've included links to the articles discussed, which are also available, by the way, at bkd.com/YETA or YETA, along with additional year-end planning resources, bios for the guests, and much, much more. Let's go ahead and get started with insights to help with your year-end tax planning with Julia.
Simply Tax.
So what is the whole premise? Like when putting this thing together, what is the year-end tax advisor?
Yeah, so historically, we've been doing the tax advisor for I don't even know how long, at least since I've been in the national office and since I've been with BKD. But basically, it's a comprehensive end-of-year resource that's put together by BKD's National Office Tax Department. We also receive input from several BKDers throughout the firm. And so the content is usually an assortment of topics ranging from just your typical year-end planning decisions, and also articles on some hotter topics that have popped up throughout the year. So we try to include a mix of both, some pertinent year-end planning topics, as well as just things that popped up throughout the year that we think our readers would be interested in hearing.
Well, and it's been a particularly busy time. So I would imagine that it's sort of a hard decision editorially to make, like what's going to go into it, what updates do you provide without overwhelming. How was that process for you and like going through that?
Yeah, a lot of it evolves over the year. I try to pay attention to kind of what people are asking questions about, just in the news, what topics are kind of popping up over and over throughout the year. So I jot those down and try to keep track and keep an eye on maybe potential authors who have either written articles on the subject in the past, or maybe they've done a speaking event to try to narrow down those topics before it comes time to actually make those decisions. So it's kind of a process that I curate throughout the year. And then once it's time to select the authors, usually they all say yes, which is great. We've got a great group of BKDers that are willing and excited for the opportunity to help out with this important publication that we put out. So it makes it my job a lot easier.
When you're kind of putting that together, cultivating that list, like who is the reader that you have in mind?
I think everyone is kind of the intended audience, especially if you're a Simply Tax listener. I think there are topics that are geared specifically towards businesses, and then others are geared more towards individuals. And we actually have the setup of the actual advisor on the webpage split out that way, so you can kind of pinpoint which topics would be more of interest to you. And BKD, as you know, puts out tons of great thoughtware content throughout the year. But the tax advisor is really intended to target a more, what I call a casual audience. So you won't find a lot of complicated tax jargon or just complicated wording and things like that inside of these articles that are going into the advisor. We really focus on simplifying the concepts for this specific publication.
So you saying that you made it simply tax, just simply tax?
Oh, one might say that. Yes.
I couldn't resist. I had to,
I
I'm
saw it
like,
coming.
this sounds, yeah, like it was like an easy layup.
Yeah.
Had to go for the layup. So I don't know. Well, and then I'm going to give you some kudos here too for coming up with the idea of, let's feature some of these great authors and kind of hear from them a little bit beyond the words on the page, kind of bringing them to life a little bit. So had a chance to chat with some of them.
Yes, and thank you for allowing me and some of the other tax advisor authors to kind of put one more bit of media out there so that their content is really reaching a large audience.
For sure. Maybe we can kind of go through and introduce some of them.
Yeah, so Stephanie Bostick's article on private foundations really has something for everyone. The topic is relevant for individuals, businesses, not-for-profits, and anyone just looking to increase their tax knowledge in this area. So here's Stephanie to give an overview about her article, Private Foundations, Beware the Hidden Issues.
So part of the article stemmed from, I had a couple of private foundations last year that had surprises. And the surprises came from those that were either managing them, so either my actual taxpayer or their brokerage firm had given them bad advice or inaccurate tax implications for the transactions that they did. So for example, one of them, they created all these long-term capital losses, and then we couldn't utilize them and they don't carry over. And so my taxpayer was very surprised that all of these losses kind of went away. And so we realized that our taxpayers don't really always understand how the private foundation works. And so we thought it would be a good idea to have a training session or an informational tool that would allow us to better help on the proactive side than a year and a half later when we're doing the tax return.
It's definitely, I think, a helpful piece, right? Is because there's a lot of, I think, misinformation, perhaps, or misconception, or maybe just a lack of understanding of how complex this area is.
Definitely. I think that a lot of people get into private foundations thinking this will be a great tool. I'll be able to manage where my money is going at the most beneficial time of tax growth. And so offsetting that avenue with being able to give now instead of having to figure out who you're going to give to now has always been good, but people don't understand exactly how complicated a private foundation is and that there's a lot of things you can and cannot do. And if you accidentally start doing those things, you can get caught off guard with a tax or an additional penalty that you were not expecting. And so there's definitely some complexities that you don't really know about until you start actually doing the return for the first year. Because it's not like in a how-to guide.
Although I think your articles maybe, because I like that, like beware of hidden issues, right? So it's kind of like the really how to not, like the things you should not do.
Correct.
Is maybe
Yes.
another way of looking at it, right?
Exactly.
But yeah, I think some of the complexity there. So what are some of those? What are some of the issues that in areas that you kind of encounter when you're going through that process?
Yeah. So one of them is with non-cash contributions. What we have many times advocated for our clients is to go ahead and put in securities so that you don't have to realize the capital gain, but instead you just flow your securities into your private foundation, which is great on a tax side. In addition to that, there are many times that our clients have maybe an antique dresser or something that is a tangible personal property item that they want to contribute into their foundation to hold for a while and then to sell in the future. And the great thing with that is that you can do it. However, if you donate something to your foundation that is not cash and not securities, and then the foundation immediately sells it, then it's not seen as a charitable purpose. And so you won't be able to get the full value of that. Instead, you only get your basis. And so that comes as a big shock to some of our clients who have contributed something. And then in maybe the year after or 2 years down the road, they know that it had already appreciated in value. And then they try to sell it. And then we have an issue with the original contribution, but also with the amount of of gain recognition there as well.
Yeah, that's an important thing to understand. And maybe a grounding question we should probably ask here, because why would you contribute to a private foundation, or why would you have a private foundation versus donor advised fund or a 501c3 organization or something like that? Well, why would you do that? And then how does that kind of intersect with these non-cash type contributions?
Definitely. So one of the benefits of the private foundation is that you do have a little bit more control. You also can include more family members. So your donor advised funds are not generally something that's going to be like the whole family can contribute to one fund. You usually have it very individualized. And that kind of eliminates some of the tax return issues when it's just siloed. But if you want to have your whole family get involved or the next generation get involved, you can do that through a private foundation in a way that you have maybe the second generation is the board members, so that then they have more of that deciding power. But it's funded through like maybe your first generation of wealth. And so that's where I see a lot of them is through a succession planning type of philanthropy approach. In addition to that, you can do a little bit more on a scale of who all you can give to. So a lot of the donor advised funds, maybe if it's like with Frost or with another bank, they have a list of pre-approved charities, and then they will allow you to bring support for other endeavors, although sometimes they kind of limit it based on what they've already vetted. Whereas a private foundation, you can kind of expand a little bit more. I've also seen private foundations be the key point to a will plan. And so in the estate, what people have done is they've set it up so everything goes into this foundation, and then the people in charge of the foundation might be, their kids at first, but then it gets transitioned into maybe a trustee who is a bank or something like that, so that it continues further. Whereas a donor advised fund is a little bit less flexible on that front.
So I would imagine from because of, like you said, it kind of creates an opportunity from succession and getting the family more involved, that then obviously there's the management of these assets that are within the private foundation. Could you talk a little bit about some of the issues that maybe would be encountered there, particularly for those that are maybe not as experienced in being a private foundation manager?
We've actually had quite a few of my clients who I've seen them set it up different ways. So managing the foundation could be more basic in that you have maybe one brokerage firm that you use. And so all your accounts are really managed by that one broker. And that's kind of nice in the sense that the brokerage firm is already kind of managing your assets for you, and you can be with them in communication for how you want it to grow or where you want your securities to be invested in, so that you are really just focusing on who you want to give money to. So that's kind of the most simplistic way. Another version that I've seen of private foundations is when you have multiple brokers, because your money is more diversified, and even to the point of investing in publicly traded partnerships or other investment partnerships that can then grow within the foundation. The biggest concern with that is just being aware that you can run into the unrelated business income tax. And that is a tax that is in addition to the normal tax of a foundation when you own something that is creating income that's not for a charitable purpose. And that's really the biggest thing that I've found people who end up managing their own private foundations that they're not aware of, because it's not the same thing as just putting your money into a brokerage account and saying, hey, grow my money as quickly as you can. If that broker starts investing in partnerships, then you're going to be creating this potential tax in the future that you just might not be thinking about when you first get started.
And that definitely adds complexity. And anytime there's an additional tax filing or anything like that, I feel like that definitely, or consideration, I guess, as you say, from paying tax, that probably also is not a very pleasant surprise, to put it nicely, I guess.
And that's where we kind of get into some of the changes that happened this past year. So private foundations are lumped in with the realm that now has this parking tax. So if you have employees and they have a parking spot and you pay for it, you could have a tax on that benefit that your employees are getting. So most of the time, a private foundation doesn't necessarily have employees, or if they do, there's not necessarily a parking aspect of that. But there are a few that the foundation is managed by multiple people and they do have employees because they're that large. And when they do then have employees that get parking paid for them, we have found a few that then have this tax that we just have to track and pay in on time and make sure that's included.
Excellent advice. I guess, is there anything else that we haven't maybe covered or that you kind of even encountered as you're putting your article together that you would add to the conversation?
I think one of the things that I've stumbled upon throughout my experience has been, what types of investments are you investing in for your private foundation? So one of the differences between what a private foundation can do and some of the other benefits is that you can hold these investment partnerships or other businesses or even oil and gas within reason. And that the biggest part is to make sure that you have diversified so that the foundation is not too risky. And so a lot of the questions that revolve around the tax return of the private foundation deal with, is the manager being too risky in their investment choices? Or is the private foundation diversified enough to be seen as truly trying to be the best for the charities in the future? And that is not a black and white answer. Accounting and just this profession, a lot of people think that there's a lot more black and white. And I think through your podcast, it's becoming more obvious to everyone that it's not black and white. But that's definitely one of those arenas that, depending on what you're investing in and your purposes and your goals, you can do a lot of different things with your foundation that can be really great as long as you're within the realm of making sure it's for the charitable purpose and you're not becoming too risky with it.
Stephanie's article was great. I had a great conversation with her. I actually learned some things from her because I know enough in the private foundation space to know that you really have to be aware that there are issues, there are things that you don't want to dabble in when you deal with it. So Stephanie, I thought, did a nice job of explaining it in a down to earth sort of way. Like you said, cuts the jargon in kind of in a way that, if you're truly interested in having a private foundation, you can relate and understand. So it was very useful. And then I had a similar conversation with a very complex area with Derek Smith. So maybe you can help to kind of tee that one up.
Absolutely. Yeah. No year-end summary, especially this year, of tax topics would be complete without a mention of opportunity zones. So yeah, let's hear from Derek Smith. I believe he's a previous and maybe a recurring guest of the podcast, and on his latest updates of the opportunity zones, which was included in our BKD year-end tax advisor.
Could you maybe give that stereotypical 30-second elevator, pitch on what these things are?
Absolutely. I think the thing to keep in mind with opportunity zones is it's a tool to allow those people in areas of our country that need investment to get that investment from those folks that have the capital to do the investment. They're tracts of land located on a map. And Congress was putting these in place to encourage investments in trader businesses that would operate in these areas that need the most investment. It's another tool in the tool chest or another avenue to add to the capital stack to get that investment the way we want it to. There's several tax benefits to the investor. And like anything Congress does, they provide an incentive through a tax benefit, but it allows investors to get some nice tax benefit and in order to get projects, businesses started, real estate built and property built within those opportunity zones.
Well, like you said, with it, there being the tax play here and a lot of the excitement that it creates. I feel like I'm also hearing a lot of, maybe confusion because it's brand new regime and new concept. So what are the biggest areas of confusion that you're hearing?
I think there is still a lot of confusion, and a lot of that confusion is coming from misinformation, people not understanding the extent of the rules that we have out there. It took a while for the IRS to get these rules to us, but now that we have them, there's a lot of confidence we have in the rules to be able to get deals done. Some of the confusion we see is people that say, "Hey, I've got land or property within an opportunity zone. What do I need to do to take advantage of these new rules?" And we have to keep in mind that if you're an existing owner of property, there is a way to get your property into an opportunity zone deal, but there's some limitations there. So I think the biggest confusion is if I got an existing business that I want to have access to additional capital to expand, or I've got existing property and you want to take advantage of the opportunity zone rules, there's a lot of planning that has to go into making that happen. And you have to be willing to give up a great deal of control if you're going to add investors that are going to want to take advantage of these opportunity zone rules. Saying that, there is a way for that to all work, but you have to do it very strategically and very carefully. The other thing we see a lot of confusion on is I want to set up a single member LLC to be my opportunity zone fund, or I want to invest directly into a trade or business in an opportunity zone, and they miss the key step of needing to have an opportunity zone fund involved. And that's a big confusion part because there's opportunity zone alphabet soup out there. There's the zones, there's the funds, there's the businesses, there's a qualified partnership, opportunity zone partnerships, qualified opportunity zone corporations. There's a lot of alphabet soup out there, but you do have to have a qualified opportunity zone fund set up, and you do have to have gain dollars to put into that. And I think that's another element of confusion that's out there. We're also seeing a lot of financial institutions that are wanting to lend on these deals, but there's confusion. They're getting misinformation from folks that are saying, well, I can't do this, or I can't do that, or I can't lend on this because I'm limited to what I can take as collateral. And it's very clear in the rules that lenders can treat this like any other deal. They can take guarantees from the Opportunity Zone Fund. They can take guarantees from the Opportunity Zone Fund owners. They can use the Opportunity Zone Fund assets as collateral. They can use the Opportunity Zone interests, the LLC interests, for example, as collateral. They can loan money to the Opportunity Zone Fund. I think there's some missing information out there, and these deals work just like any other deal. Now you have to be careful, right, Damien, with anything. If you have to take some of those assets, it does have some tax ramifications to the Opportunity Zone Fund owners if some of those collateral assets that are in the Opportunity Zone Fund have to go to pay off another debt. But that's part of what we have to work through to make sure everybody's comfortable. But you can lend against these assets and use them as collateral and loan to these assets just like you would any other deal. I think those are probably the three biggest areas we're seeing confusion on right now.
You mentioned about the need for conversations for planning in advance. Kind of what's your take and what are you seeing in terms of the amount of time that you really need to dedicate to that? Because I'm particularly asking because I know that coming up here, there's maybe a deadline you look at, or maybe a rush there'll be before the end of the year. So maybe you could talk a little bit about that, and then what steps you need to be doing and how soon to be working towards that.
I think the key thing is to be working with advisors that are familiar with these rules, that have been spending time like we have at BKD working on these deals and studying the rules and understanding them so that you can do things the right way. There's a major deadline, December 31st of 2019. Investments that happen after that date aren't going to be eligible for the full 7-year step up in basis. Now, the good news is they'll still be eligible for deferral. They'll still be eligible for the 5-year 10% step up, but they'll miss out on one of those benefits if they happen after December 31st of 19. And I think that's one of those things that we have to spend a great deal of time planning on. We've already had a couple of a couple of time frames where we've had to get some deals done at a short amount of time. So the longer you have to plan, the better. And the more foresight and planning you do, the better your deal's going to turn out. At the end of the day, what we're talking to clients on, if this can work out before December 31st of 19, great, but let's not do a bad deal just to try to get it in before that deadline. It's more important that we get the deal done correctly and that it's structured appropriately to take advantage of these rules, because there's a big benefit at the end if we hold it for more than 10 years. As you know, Damien, that 10-year after 10-year tax-free appreciation, we don't want to mess that up. We don't want to mess the deferral up either. So I want to make sure to do it right, but there is an upcoming deadline here of December 31st that we need to be watching for.
Yeah. We were talking on our webinar back in August.
I'm going to interrupt myself here real quick and invite you to check out an archived recording of the August 8, 2019 webinar that I just mentioned, where Derek and I sat down with our colleagues Jeff Bodkin and Susan Jones to share what we learned from applying the tax reform provisions to individual taxpayers this year. We held a similar webinar with Insights for Businesses on August 9, 2019, and we've included links to both in the show notes to this episode.
You were kind of giving the update and the overview of kind of what we've seen from doing this in practice. You were kind of talking about the fact that there's maybe a lot of interest, a lot of kicking of the tires, and a lot of capital maybe that's kind of ready to deploy. Anything you would add to that? Would you agree with that? Are you seeing that? And is that starting to actually shift into getting those investments made here, particularly with this kind of upcoming end of the year push?
Yeah, I think we saw, Damien, kind of a drop off in interest in opportunity zones as everybody got their funds set up, by the end of June. They kind of said, don't bother me for a little bit on opportunity zones. I need to take a minute. I rolled my capital gains into my fund and now I'm looking for new deals. And it's kind of a hurry up and wait type of thing there for the last several months. But we're starting to see with that December 31st, 19 discussion surrounding a lot of these deals, interest picking back up. We've got people with money and funds, people who've sold some things in 19 looking for good deals. And now, thankfully, as we talked about last time, what we were missing were good deals. We're starting to see good deals coming online, hotels, retail, trades or business, software companies, manufacturers, light duty manufacturers. We're seeing the gambit coming into the opportunity zone space and saying, hey, we're going to be in this, looking to place this new whatever it is. And this sounds like a great way for us to help get some additional capital to make our deal work even better than it would have, or make a deal that we formerly couldn't get done for lack of a capital, maybe get that deal done. So I think the other thing that's along with that we're seeing is people are starting to dust off the ideas or deals or trades or businesses that they really wanted to start in one of these areas but couldn't get enough funding. Now these areas with this opportunity zone designation become more attractive. And these folks that were wanting to do something there are now able to go out and possibly put a deal together. So lots of fun times coming with opportunity zones, and we're starting to see those businesses and those investment opportunities become available for those folks that have funds set aside to do that.
Interesting times for sure.
Mm-hmm.
And it sounds like, maybe where the rubber's actually starting to meet the road in terms of implementing some of these things and some of the nuances. But anything else that you would add that maybe we haven't covered or chatted about?
One small thing I'd add, I think I've heard and seen a lot of articles written that, this opportunity zone designation is, only going to benefit deals that would have been done anyways. And there's been some discussion around that in various news outlets. I would tell you, we're seeing deals that would not otherwise be able to get done in these areas that are now going to be able to move forward, get financed, and provide a benefit to these opportunity zone tracts of land that absolutely need that investment. Are there deals that would have been done anyway? Sure, that is happening. But those deals are better deals now than they would have been and less likely to have problems because of that additional influx of capital with this opportunity zone designation. But we are definitely seeing deals that would otherwise not be done if it weren't for this piece of tax legislation. So I think it is accomplishing what they wanted to accomplish. It's taking longer than we would have liked to see it take, but I think it is accomplishing the goal that Congress set out to accomplish with this designation of opportunity zones.
Definitely a great opportunity to talk to him. I really was in the zone on that one. It was a lot of fun. I'm in a goofy mood today, apparently. So
Just today.
I'm never goofy like this.
Mm-mm.
Okay. Actually, Derek is somebody that clearly we've had on several times. We will continue to have him on because he, I think, again, like you said, something for everybody with the way he explains this area that's just brand new and a lot of terminology and is, I think, really helpful. And I've gotten a lot of feedback from people that have listened and said, wow, I never really understood that concept, or I didn't know how it was going to work in practice until I listened to Derek explain it. He definitely just did that in our kind of explanation of the whole thing. It's good stuff.
If you're curious and would like to hear more from Derek, I wanted to cut in here real quick and encourage you to check out episodes 41 and 45 of the podcast.
Another exciting area, at least from my perspective, is accounting methods. I guess what was your thought in kind of including something on that topic?
Yeah, so tax reform, super hot topic, has added several planning considerations and also some opportunities for both individuals and businesses. And one of those considerations, especially for businesses, that they should be aware of and talking through with their trusted advisors is accounting methods. So here's Dodge to share a bit about his year-end tax advisor article on that very topic.
An accounting method determines basically the timing of when income or expenses are recognized for tax purposes. And really, there's two main types of accounting methods. There's your overall method, which is whether you're a cash basis taxpayer or an accrual basis taxpayer. And then you can have accounting methods related to the treatment of like particular items, which could be like inventory or long-term contracts or prepaid intangibles, things like that. Once you adopt a certain accounting method, you have to apply it consistently going forward. So you have to stick with the treatments that you've been doing. And in order to change an accounting method, that requires IRS consent. And that is done by filing a Form 3115 with the IRS. There's really two types of 3115s. There are ones that require advanced consent of the IRS, or we call those non-automatic changes, where you actually have to file it with the IRS and they actually have to approve it. And you usually have to pay the IRS a user fee associated with that. And there's other accounting method changes that, the IRS has determined are automatic method changes. So all you need to do is file a 3115 with the IRS and they will automatically approve that accounting method change. And then you can apply the new method going forward. When you file an accounting method change, there's obviously, a difference, an adjustment to the way you've been treating that particular item. And so some accounting method changes allow for what's called the Section 481A adjustment, which is basically where you take the, cumulative difference in, the new accounting method and the old accounting method, and you recognize that in your taxable income. So if the adjustment is favorable to you, so if it's a deduction, you're allowed to take that deduction all in the year of change, the year that you make the accounting method change. But if the adjustment is positive, so it increases your taxable income, or it's unfavorable to you, then you're generally allowed to spread that unfavorable adjustment over 4 years.
I was just actually talking with Travis Butler and Brittany Cummings about that, having a conversation about just how many accounting methods there really are out there. And I mean, personally, I know, and I've heard from others that it just can be so overwhelming at times. But I guess to that end, are there maybe a few key accounting methods to focus on here after tax reform?
Yeah, you're definitely right. There are tons of different accounting methods out there, hundreds probably, but there are a few key ones that we focus in on, and especially like you said with the TICJA, there were some very taxpayer favorable changes that were made there related to a few accounting methods, and those, I guess I'll talk about those first. The new changes under TICJA starting in 2018. These changes generally apply to small taxpayers that have gross receipts of less than $25 million. And that's your average annual gross receipts for the past 3 years. So if you meet that threshold, there's some new opportunities to use some favorable accounting methods. And the big one, I think, is probably the overall accounting method, the ability to use the cash basis of accounting. Previously, if you were a C corporation, you generally had to have less than $5 million of gross receipts to be able to use the cash method of accounting. And now, under TICJA, that threshold has increased to $25 million. So there's a lot of taxpayers in between that $5 million and $25 million threshold that maybe before weren't allowed to use the cash method and now are able to do that. And so, you just got to look and see if that's a favorable method change for you. And I think, for a lot of taxpayers, it is. So, under the cash method, income is, taxed when it's received in cash and expenses are deducted when they're paid. And so if you've got, receivables exceeding your payables, then there could be a net deferral of income there, which would be favorable to you. So you're allowed to do that on an automatic 3115. And then if it's a favorable adjustment, then you can take that deduction in the year of change. So I've done this for several of my clients, and a couple of them had some 481A adjustment deductions that were in the millions of dollars for 2018. So this is definitely something to look at if you're a C corp and you're under $25 million in gross receipts and you're currently on the accrual method.
Yeah, it's been pretty impactful, man. I mean, I'll echo that and say that I've seen and even heard of some really sizable adjustments all in 1 year.
And it is a timing difference, but to the extent that things kind of stay consistent from year to year, that could you can get that deferral, and it might not reverse for a long time. Yeah, definitely worth looking into.
Yeah, and speaking of some things I need looking into with the end of the year quickly approaching here, what are some accounting method considerations that we should be taking into account?
I think it's always worth looking at accounting methods because, like we talked about, they can definitely provide some significant deductions. And so there's a couple that, I always look at, especially going into year end, to see if they might be beneficial for some of my clients. And so prepaid intangibles is one of them. With prepaid expenses, generally you're capitalizing those in your books and amortizing them over the life of the contract. Prime example would be like prepaid insurance. But there's an accounting method that you can elect for tax purposes, where as long as those contracts don't extend beyond 12 months, then you can deduct those when paid. So that's if you're not currently on that accounting method, you should take a look at your prepaid expenses, see if they qualify, and that could potentially be a significant deduction running through that 481A adjustment. And then another one that I always look at is cost segregation studies. This one is kind of cool. It can also result in some big deductions. And what a cost seg is it's an engineering-based study where our engineers actually go in there and look at the components of a building and break them out into their different class lives. So instead of, if you put a building in service, typically you would just depreciate that over a 39-year life. But with the cost seg, you can break that out into some potentially, 5, 7, 15-year shorter life assets, and those might qualify for bonus depreciation. And so you can get some accelerated deductions there. And so, obviously, if you put the building in service during that tax year, then it's not really an accounting method change. It's just you're establishing your method of accounting there. But you can go back as long as you want and look at buildings that were placed in service in previous years. And then, do an accounting method change, and the cumulative difference can be ran through as a 481A adjustment. So I've had taxpayers do that. It was really big, when we were looking at permanent tax savings because of the reduction in rate, but it's still a great planning opportunity from just a deferral aspect. So
It's definitely a good idea to have some of those in mind, have some of them in front of mind, and be on the lookout for them as we get into year end here. But covered a lot of ground, and your article does as well. Does a really good job. But is there anything that we haven't covered or talked about at this point that you'd like to add to the conversation?
Yeah, I guess one more thing to mention is, we talked about some accounting methods that can be favorable and provide you with a deduction. But another thing to think about with, as far as just planning and managing risk with your accounting methods is that, if you determine that maybe you've been treating something incorrectly in the past and that comes to your attention, in some cases you can do an accounting method. And, although the adjustment would be unfavorable to you, you get audit protection. So, as soon as you file that accounting method, the IRS can't come in and audit prior years related to that issue. And then also, if it's a bad answer for you, then you can spread that over the 4 years, like we talked about. So that's just another thing to consider. An example would be like, accrued bonuses. If maybe you determine that you've been deducting your accrued bonuses that have been paid within 2.5 months historically, and that actually your bonus plan doesn't qualify for deduction when accrued, then you could actually do an accounting method change to correct that and get yourself audit protection in a 4-year spread. So just another thing to consider.
So at first glance, a reader may think that the topic of this next article isn't very casual, as I promised that the year-end tax advisor articles are, but it really is something that every taxpayer should read, so don't let the name scare you off. Yelena Bosovik and Kim Jones, their article on mitigating penalty exposure through proper use of Forms 8275 and 8275R discusses the issues related with items or tax positions that aren't adequately disclosed on a tax return or those that are contrary to a regulation. Now, with all the technical and drafting errors within the Tax Cuts and Jobs Act, tax reform, the use of these forms is likely to see an uptick. So we thought this was an important time to bring up this topic. So I'll turn it over to Yelena, and she's going to talk a bit more about this timely article.
You wrote a very interesting article for our year-end tax advisor on something and a topic that I think catches people off guard, I guess, because you would think like, wait, how could there not be correct tax treatment? Or how would you not be sure? Can I just call my CPA and ask them what the answer is and they're going to put the right answer on my tax return? But obviously, I think you and I both know that that's not always the case. So could you maybe give an example of a time when maybe there isn't a clear, correct tax treatment?
I think we can always hope that the law would be clear and that the legislators and the Treasury and the IRS and everyone who's writing the regulations are writing it clearly, and we can apply it and understand how to treat every item of income or deduction on our tax returns. But unfortunately, it doesn't always happen. So usually you have this idea of adequate disclosure come up when you have technical errors. So when the law itself is written incorrectly, and we've seen a lot of that with the recent tax reform legislation. There have been several bills proposed to fix some of the technical errors in there, and we haven't seen anything out of Congress to fix that yet. So there's some uncertainty around issues like that. Sometimes the statute's just not written clearly, or there's a debatable point where you can read the language either way. As far as a specific example, there's actually some research I was doing recently on the treatment of old 163J interest that's carried over from prior to 2018, and whether you can make a trade or business election and exempt some of that interest through that election, even though technically it wasn't available before 2018. So something like that where the law isn't clear and different tax professionals and tax advisors and anyone who reads the tax law can interpret that differently and can apply that differently. Again, it's something that's not clear, and a lot of times we advise taxpayers to disclose something like that or make sure they have substantial authority before they take a position either way based on how they read the regulation or the law.
Yeah, that definitely creates a little lack of clarity when the guidance is not actually there. What do you need to do? And how do you file if you don't know the answer?
What's part of what I love about tax law is there's, I feel like, rarely an answer. It's always you have a different levels of comfort, and it's kind of our job as tax advisors to help taxpayers figure out what position to take on their tax returns. And sometimes it's frustrating not to have a clear answer or a black and white area, but usually if you have wise counsel and someone who's helping you walk you through it and navigate all the rules, you can usually figure out how to proceed.
I'm biased, but I couldn't agree with you more. I think that is the what keeps it interesting and kind of keeps us coming back for more, I think, as tax professionals. But there is maybe a risk in a tax position that is ultimately incorrect, I guess, in taking that position. Could you talk a little bit about that risk and really what it is?
So if a position that a taxpayer takes on a return results in an underpayment of income tax, the IRS will usually impose a penalty that equals the portion of the underpayment attributable to a substantial understatement of income tax and multiply it by 20%. So this is known as the accuracy-related penalty, and it also applies to a tax underpayment attributable to negligence or for disregard of rules or regulations. So the threshold isn't actually high to trigger this penalty. An individual who understates his or her tax by more than 10%, and that goes down to 5% if the return reports a Section 199A qualified business income deduction, or $5,000. So whichever is greater, and can end up, if you fall into that threshold, you can end up with this penalty. For corporations, it is the lesser of 10% of the tax required to be shown on the return for a tax year, or if greater $10,000, and then or 10 million. So basically, you kind of think 10 million is the threshold. So if you understate your tax by 10 million, that penalty will be applied. So the risk is basically there will be penalties that are applied if you have a substantial underpayment of income tax.
What are some things that you can do to reduce that risk?
So this penalty can be reduced or completely avoided except in cases with tax shelters. If there is substantial authority or you adequately disclose the relevant facts on your return and have a reasonable basis for taking a tax position. So there's a few legal terms here, but the two standards that taxpayers should primarily understand are substantial authority and reasonable basis. Substantial authority is when the weight of authorities supporting the tax treatment is substantial in relation to the weight of the authorities supporting contrary treatment. So it's an objective balancing test that involves an analysis of the law and application of the law to the relevant facts. If there was substantial authority for the treatment of the item causing the understatement at the end of the tax year or when the return is filed, then you can generally avoid the penalties without disclosure in the return. However, it is important to retain written documentation of conclusions reached and authorities relied on to support the fact that there was substantial authority for the taxpayer to rely on when their tax return was filed. Reasonable basis is the trickier territory because it's a high standard that's kind of vague because it's less than substantial authority, but more than not frivolous or not patently improper. The technical definition of reasonable basis is a return position that is reasonably based on a statute, regulation, court case, revenue ruling, revenue procedure, or any other listed authority in the regulations, taking into account the relevance and persuasiveness of the authority and subsequent developments. So if a tax position has a reasonable basis but is not supported by substantial authority, it's like that middle ground, then you should consider disclosing what you're doing in the tax return to avoid the penalty. So, in layman terms, a disclosure is simply an additional explanation for a certain item on your return that could protect you from this accuracy-related penalty.
What are some of the best practices in doing that disclosure? Because it seems like that's probably, you know, I guess from my perspective, kind of thinking what is disclosure, how much do you need to do, when you need to do it, that sort of thing. So, what are some tips for doing that?
Yeah, so I might be biased because I'm a tax professional, but the best thing you can do is consult with a tax advisor. It's our job to know these things and to help our clients consider relevant authorities to help them determine the treatment of a certain item of income or deduction or any other tax position they might want to take on a return. There's an annual IRS revenue procedure that identifies when disclosure of an item or position on the return or an attached schedule or form will reduce the understatement of income. Otherwise, if disclosure is necessary, Form 8275 or Form 8275-R should be attached to the return. Known as a disclosure statement, Form 8275 is issued to disclose items or tax positions that aren't otherwise adequately disclosed on a return. Form 8275-R is called a regulation disclosure statement, and it's used to disclose tax positions taken on a return that are contrary to a regulation. So the most common question we get on these forms is how much disclosure is necessary to avoid penalties. According to the form instructions, the disclosure must include information that can be reasonably expected to apprise the IRS of the identity of the item, the amount, and the controversy or the potential controversy. For Forms 8275-R, the statement should also include an explanation for why the taxpayer believes the regulation has to be invalid. The disclosure should be carefully crafted to meet the requirements without providing unnecessary information or legal argument. Basically, you're required to disclose just enough detail to tell the IRS what you're doing, but you shouldn't go overboard. You should be short, concise, and there's not much of a focus on the legal argument, but just kind of pointing out the item and the potential issue. No one wants to draw the IRS's attention to uncertain tax position, especially when disclosure generally is not mandatory. However, adequate disclosure and consultation with tax advisors on how and what to disclose may reduce a taxpayer's exposure or completely help avoid penalties for tax underpayment. So when in doubt, our advice is always to ask your tax advisor because it's our job to help you and to know these things.
I think it's definitely an area that I guess in my experience we're seeing a lot more of after the TCJA and would you kind of agree from what you're seeing and hearing as well?
Yeah, for sure. I mean, there's so much unknown. Obviously, it's a whole new tax law, and there was a whole flurry of proposed regulations issued, and we're waiting in a lot of final regulations still. So there's still so much unknown, and in the meantime, taxpayers still have to file tax returns. There's no pause button to wait for the law to be final or clear. So as taxpayers proceed, there's definitely gray areas or areas where the law could be read either way, and sometimes there's big numbers at play, and you don't want to just guess or take, the wrong deduction or report something incorrectly. And so sometimes you do have to consult with your tax advisors to figure out the best approach and to see if there's substantial authority so you can proceed without disclosing it in the return. And if there isn't, then you can work with your tax advisor to formulate and craft adequate disclosure on the appropriate forms.
Again, well said. I really enjoyed your article. I think it really helped to bring some life to an area that maybe hasn't seen as much attention historically, but is, I think, very timely, very, very relevant, very important right now. So is there anything else that you'd like to add that maybe we haven't touched on from your article?
I'm a lawyer, so the advice I always give in everything is write it down. Documentation is really important here when there are uncertain tax positions. Filling out a Form 8275 and having reasonable basis are major requirements for adequate disclosure. But there's also the requirement that if you fail to keep proper books and records or fail to substantiate items properly, then you can't avoid the penalty by disclosure. So if you're unsure, just document. And any substantial authority you find on point, any decisions made, just making sure everything is in writing and properly documented. So that would be the word of caution, I guess I would end with.
So another big area that I feel like is kind of a recurring one, perhaps, is in the area of charitable tax planning and some reminders there. What did you have for us in that area this year?
Yeah, so an article on charitable giving reminders, like you said, it does have a recurring role in every BKD year-end tax advisor. In this article, the topic is near and dear to many taxpayers, and so we feel that it's our duty as trusted tax advisors to help make sure our clients get the mechanics right so they don't miss out on some valuable tax benefits. And Luke Guttermann actually took on this topic for the 2019 advisor, and here he is to provide more insight on his article.
One of the main things that I saw in talking to some of the charitable organizations that I work with, where people were kind of afraid that with the change in the they did away with the personal exemption, but the change in the standard deduction amount going up, that less people were going to be able to itemize, and then that charitable contributions were going to go down overall for all charities. Now that we've been through, most of the 18 season, I have not seen that where people intentionally decrease their charitable giving without having some sort of plan in place to make sure that they're still giving what they had in the past. And that's kind of where one of the things that is talked about in the article about bunching charitable donations. Basically, that would mean taking what you would give in 1 year and grouping it together with 2 years, and then doing your giving every other year. And so I've seen a few people do that just so that way they can make sure that they get over that standard deduction threshold every other year at least, so they get the benefit of their charitable contributions. Another question that came up relating to bunching was, well, I don't want to give the charity. I want them to have a steady stream of income rather than one big bulk here every other year. And one thing to utilize, or that we've told our clients that they may look into, is using a donor advised fund. And basically what the donor advised fund does is it is a qualifying charity. You can make contributions to the donor advised fund and get a deduction for it. And then they will hold those funds until you advise them where to contribute to that. Now, looking into donor advised funds, it's not as straightforward as a charity. Sometimes those funds have limitations on who they can give to and certain other requirements. So it's always good to check out which donor advised fund you going to want to utilize. But that's one way of getting your deduction in 1 year for basically 2 years, is you're bunching those together, giving it to the donor advised fund, then they can spread it out to the charity over time. Now, another thing with donor advised funds, they can't fulfill pledges that you make. They're not allowed to do that. So don't send them over, oh, I pledged this to give to this charity, and they won't be able to do that gift for you.
And kind of speaking of some of those, like those hoops you jump through and kind of understanding how it all fits together, documentation, substantiation, I feel like that's always a challenging thing for people to keep in mind when they're wanting to do kind of just the general gifts, the non-cash gifts. Could you talk a little about the requirements and maybe some best practices?
With non-cash gifts, you're always going to need to get a receipt for a non-cash gift. You're going to need to have the value written down on your receipt so that way you can track it. Now, if you give more than $500 to any certain group of property, you'll have an additional filing requirement on Form 8283. And that basically, you're just going to have to list out the charitable organization, the date that you gave the donation, and the value of the non-cash contribution that you gave. The other one, now, if you give property in value of in excess of $5,000, you're supposed to have a qualified appraisal on that. You will still fill out the 8283, but there's some additional lines that you'd need to fill out with that, listing out who did the valuation and a few other items, just so that way they can verify the gift and the amount that you're giving. Now, this $5,000 requirement does not apply to marketable securities that are on a public exchange. So when you give your appreciated stock, which is something that a lot of people like to do, because one of the main things with appreciated stock is that you don't have to recognize the gain on the stock, but you get that step up in base or the step up value to take your charitable contribution amount. So that's a non-cash contribution. You would have to fill out the 8283, but you wouldn't have to get an appraisal because it's publicly traded. And normally you pull up the historical stock data and you could put that in there for the average of the high low on that day and put that in as your charitable contribution. Now, one thing to note on when you give marketable securities is that you want to make sure that it is long-term capital gain property that you're donating, because that's where you get that step up in value for the contributed amount. Now, if it's going to be short-term gain property, you won't get the step up in value. You would only get the cost basis that you have in there. So that would kind of nullify any benefit of giving those marketable securities.
I hate to say like the word issue or challenge or whatnot, right? But I mean, I kind of feel like those are things that come up when dealing with contributions. Are there some common ones that I guess you've seen and heard in practice?
I've always seen not having your documentation and everything lined out. There have been some cases out there where somebody didn't fill out the 8283 properly and the IRS denied it because they didn't have the cost basis listed on the form. So it's always good to make sure to go through and make sure that you have everything listed out and properly documented. And this goes for non-cash contributions as well as cash contributions, because on cash contributions, if you give a large contribution, you're going to want to make sure that first off, if you have a cash contribution of 250 or less, you just need some substantive support for that, and that could be a canceled check, bank record, a receipt from the charity. Those are kind of the main items. Now, if it's greater than 250, you have to have that charitable contribution receipt, and it has to be a valid one. It needs to list the date, the amount of the gift, and that no goods or services were received in exchange for the gift that you made. Now, if you did receive something or some goods or services in exchange for that gift, that amount and what you received needs to be listed on that charitable contribution form. And so you kind of can see, oh, I gave, $5,000, the dinner or whatever else that I received, the auction gift that I got back was worth $1,000. My charitable contribution is $4,000. So it's really imperative to make sure that you have your documentation checked, because the IRS has been very unforgiving as far as throwing out some of those donations or those deductions if your documentation isn't perfect.
Great pointers, great practical application takeaways here. Is there anything that I guess you'd add at this point from our conversation that maybe we haven't covered?
Well, one thing to also cover as we kind of are getting into how Tax Cuts and Jobs Act is affecting charitable contributions. One thing for people to remember as they get over 70 and a half is a qualified charitable distribution from your IRAs. And basically what this is that rather than taking your required minimum distribution, you can give that directly to a charity, and that counts for your required minimum distribution. You don't have to pick up that in your income, and it goes straight to the charity. Now, you don't get a charitable deduction, but you also don't have to pick it up in your income. And so there you don't have to worry about the standard deduction. And for people that are over 70, which you have to be over 70 and a half to have this, they're generally getting Social Security. It can also keep your income low, so that way more of your Social Security can be non-taxable, essentially. And with this, again, back to the documentation, it's key that you follow that the funds go directly from your IRA to that charitable organization. They can't come out and go to you or anywhere else. They need to go from your IRA to the charity, no stops in between.
Yeah, that's an important one because there have been some situations that you've seen out there where that didn't happen, and again, that's kind of game over, right?
Yes, I agree. And for our older clients, the QCDs are pretty nice because you don't have to worry about your RMD. It's taken care of. You don't have to go and worry about donating stock or writing a check or anything else along those lines. You just have the IRA, send it over to the charity, and then you're good for the year, and you don't have to remember to make sure you get your charitable receipt or anything else along those lines, and it's over there and done. I mean, you still should have your charitable receipt, but it's basically out of your hands.
Well, I feel like that's one of those topics where there's a lot of like urban legend or myth or misunderstanding. Like, my great aunt told me that I can deduct my socks, and then that's just becomes like a thing. I don't know. There's like just these incorrect statements, I feel like, that have kind of been out there. And I feel like it's also maybe because the rules have changed. So
Sure,
very
yeah.
helpful to have kind of that regular check-in and some good reminders. I think another area of the tax law where there's been probably some confusion, and it's also because it's new, is our favorite code section, 199 Cap A.
Yes. So similar to opportunity zones, we would be remiss to leave out an article on the qualified business income deduction in this year's tax advisor. Karen Fleming's article, section 199A, doesn't stand alone. Does a great job of looking at this new deduction from a different perspective. It does that by tying in some other aspects of the tax law that kind of help shape our understanding of QBI. So here's Karen.
So during 2018, it was really interesting as we got into each client situation. I felt like you had gone through all these trainings and you felt really prepared to put QBI on your return. And you thought, I know this, going into each and every return. And every client you pulled up, their fact patterns added new questions and new nuances. And then you started to say, okay, how can I apply what I just learned to this client's situation? And as tax practitioners, we generally draw on what we already know. And so one of the first things we started to document with the QBI was net investment income tax. We said, okay, there's got to be some parallels here. We already had to answer a lot of these questions when we were documenting our NIT. And there has to be something in that documentation that helps me with QBI. And the most interesting thing I found when we were going through that analysis on each and every client is there really aren't a lot of parallels. Although your documentation and your facts and circumstances about the client were helpful in learning how to apply QBI, a lot of the answers to the questions we were asking, material participation, what perspective are we looking at it from the business or the taxpayer, were not the same as we were analyzing that. And so in the QBI analysis for each and every client, I felt like we were sort of relearning the client. Mm-hmm. And the best thing that came out of it, I believe, is documentation.
It's funny, and I couldn't agree with you more. As Jesse Palmer, our director of tax quality control, he frequently has said, document, right? So what were some of the biggest challenges that you faced when applying Section 199 Cap A?
I felt like the biggest challenge is sometimes your gut instinct, your intuition as a tax practitioner was brought into question. You would get to a situation with a self-charged rent with an S Corp business and think you knew the answer that was going to come out to fruition on the individual income tax return. And then you'd walk through the steps of QBI, and it wouldn't necessarily be the exact answer you were expecting. But I think as we saw more and more of those typical scenarios, a self-charged rent scenario, is the taxpayer the owner of just the rental or just the S Corp? Do we have 5 different entities that we're considering aggregation? And as you walked through some of those more baseline examples, 1, 2, 3, 4, 5 of them, then you started to feel a comfort with it that you didn't have on day one. It just took walking through a couple of the typical scenarios to really understand how it was going to play out. And there really wasn't enough that you could have done in training ahead of time that prepared you unless you were digging into it.
Yeah, I totally agree with you. I mean, I think the best way I found to learn it was to apply it in practice to real life examples, real life fact patterns, all that kind of good stuff. So I don't know, did you learn or maybe were there any key lessons or takeaways from applying this new code section?
As I previously mentioned, I felt like we were expecting a lot more of our historical tax practitioner knowledge to come into play with QBI. And the preamble to 199A does a really nice job of explaining when there was an intent to draw on other sections and there was an intent not to draw on other sections. As we talked through trader business documentation, we found that that was a conversation that sort of had died out over the last 5 or 10 years potentially, and now was brought up again. Are we a 162 trader business? Again, material participation. What are our groupings? What activities are we putting together? What does our documentation say? What historical positions has a taxpayer been taking? And how does that impact our aggregation decisions or our QBI decisions? And so although our answers didn't always line up, potentially 199A drew on one section of the code or the definitions, and 469 was drawing on a different code or intersection. So although we were expecting more of an intersection, I felt like the preamble to 199A really outlined where to go and where 199A was pulling from other sections of the code or not pulling from other sections of the code intentionally. Mm-hmm. And I think all tax practitioners, if they haven't already, need to read that before we go into the 2019 tax year filing season. Refresh yourself. Now that you've walked through 10, 20, 30 examples, remind yourself what really was the intent of this. And then I think 2019 is really a call to increasing that documentation. We were encountering hundreds of pages of new legislation last year. And although we were learning it and documenting and preparing it as much as we could, we have 12 more months of knowledge under our belts now, and really reanalyzing each one of those taxpayers as we go into 2019 and making sure we took all of the correct positions with that 12 months of experience under our belt, I think is going to be the call to action for next year.
Yeah. No, excellent points. And I think it was a particularly tricky year for tax practitioners. And there are many things just like this that just took more time and caught, I think, a lot of people off guard based on the conversations that I've been having. So yeah, do you have any advice for your end and maybe beyond based on what you've been seeing and hearing?
My biggest piece of advice is that a lot of client documentation lives in a tax practitioner's mind. They know their client. They've been working with their client. And really, I felt like 199A was a call to write it down. We need to know exactly where this client is falling under their material participation, under the hours invested in that business, whether they're a rental real estate professional. And this isn't information that should live in somebody's head. It is information that should live in a permanent file, documented on each one of those clients. And it helps support so many different areas of our return. And 199A just re-highlighted how important that information is to know on each and every one of our taxpayers.
I will say that no Year-End Tax Advisor would be complete if we didn't have an article or two from you. So what do you have for us this year in terms of content?
Yeah, this year I don't know if I'd say I lucked out, but I did kind of transition more to a reviewer of articles and took a back seat in the authoring aspects. So Jessica Cox, she's an associate in our national office tax team. She actually authored the next article that I want to talk about for this year's advisor. And it's on the topic of student loan repayment programs. And this has been a bit of a hot topic recently. So we wanted to make sure to include it in our 2019 tax advisor.
Yeah, you do an excellent job on the editing and the curating side of things. So on that topic, reading Jessica's article, what are student loan repayment programs? And I mean, I guess why are we talking about them in the first place?
Great question. Yeah, student loan repayment programs, they're kind of a new benefit that employers are starting to offer their employees as a way to help attract and retain top talent. The struggle to get good qualified talent into the workplace is becoming a top priority. And one of the ways that an employer can stand out is by kind of diversifying their benefit packages. And these programs are one of those ways that employers can do that.
Actually, personally, I've worked with a taxpayer that was kind of facing the same thing, is very interested in this area because the biggest challenge, I think, for a lot of business owners is like the competition for talent. And student loans have been in the headlines so much. So it's sort of, it's an interesting thing. And obviously, it's some developments this year. So I guess, could you talk a little about those and what Jessica covered in the article from that perspective?
Sure. Yeah. So there was a 2018 private letter ruling issued specifically to an employer that kind of laid out the criteria that must be met to allow a company to use these student loan repayment programs as a part of, in this case, it was used as part of their 401k plan. And under that plan, specifically under that plan that was included in the private letter ruling, the employer in that case would continue to make matching contributions that it normally would to its employees' retirement accounts that were both based on the employee contributions, but it went a step further and also allowed that employer to make matching contributions that, air quotes, matched based on an employee making student loan repayments. And so what this setup does is it helps address a concern that a lot of employees face, especially those that are entering the workforce straight out of college. I'm sure a lot of your listeners can relate. Once you kind of leave college and you're starting out on your own in your new job, you kind of have to make the decision, am I going to put money towards retirement or am I going to start tackling the student loan debt? And so this new benefit program kind of helps those employees get a head start on their future retirement potential while also maintaining their duty to repay that student loan debt. So it's a win-win.
So I guess though, with anything, there's obviously some, I don't want to say hoops to jump through, although that's probably it, right? Because I mean, 401k, that's a very complicated section of the Internal Revenue Code. There are some pitfalls, some things to watch out for, maybe some concerns. What are some things to keep in mind, I guess, what is related to, the key takeaways from the letter ruling?
Yeah, so I'd recommend your listeners actually go out and read the article, but just a quick snapshot of kind of a key takeaway there is to keep in mind that private letter ruling only applies to the taxpayer who requested it. So that criteria that was set out it's kind of a play-by-play that future employers could use to replicate that benefit program, but you really don't have protection against audit or anything like that to say that you have approval to kind of set up those programs unless you were to request a similar private letter ruling. However, with that said, the increasing importance of this topic has prompted the IRS recently to begin developing guidance that all employers can use and rely on related to these student loan repayment programs. So this is something that we expect to kind of develop in coming months, coming years. Hopefully more guidance will be issued so that other employers can kind of jump on this bandwagon and help diversify their benefit programs in a way that the employer mentioned in the private letter ruling has done.
It'll be interesting to see how that comes to bear, and hopefully that more people can feel comfortable and utilize it, because I think it is a very good benefit. Kind of matches a need with some changes and developments in the tax area.
Absolutely. It's very exciting.
So, speaking of all this excitement, I guess we've covered a lot of ground. We've talked to a lot of different people, heard from a lot of different people, the articles, the authors. There's a lot more out there. I guess, is there anything else that you add to kind of bring all this sort of full circle, and what else is out there?
I would encourage your listeners that while they are out perusing the year-end tax advisor, to be sure and click that little red button to subscribe to BKD Thoughtware. Like I mentioned, BKD puts out great content just like this all year round, not just at the Year-End Advisor. And you don't want to miss out. So go ahead and subscribe so that you are the first to receive that content when it's released.
I'll leave you today with the link to the Year-End Tax Advisor that we've been talking so much about, so you can check out the articles for yourself. And that's bkd.com/YETA, or YETA, which is short for Year-End Tax Advisor. Show notes of this episode are also available at bkd.com/simplytax. And you can learn more about me out on Twitter, where I tweet about tax at Damien Martin CPA, on Instagram, where I post about my life at the intersection of tax and being a dad at TaxDad, on YouTube by subscribing to our Simply Tax YouTube channel, and out on LinkedIn. I'm Damien Martin, and thank you for listening.
The information contained in this episode of Simply Tax is based on data available as of the date of its release. BKD is under no obligation to update this information if changes occur. Applying this information to your specific situation requires careful consideration of all facts and circumstances. Any information provided is not to be considered as tax, legal, or financial advice. Please consult your tax advisor before acting on any matters covered.